Since today's Fed Day, we're going to tackle what our next guest calls the bubble of modern banking and what investors can do about it. Author, founder, and editor of Grant's Interest Rate Observer, Jim Grant, joining us. Jim, always glad to see you. Welcome back to Money Moves.
Thank you.
So today is Fed Day. Most people say unless Ben Bernanke himself goes for QE3, it is not going to happen. But this doesn't change the overall environment. What is an investor to do? Cry, drink, go home?
Drinking helps, but not during business hours.
That's right.
To begin with, perhaps we should introduce some mental hygiene into this Fed announcement. The Fed will say almost certainly that it remains highly accommodative. In place of the phrase highly accommodative, mentally insert the phrase highly manipulative.
Okay.
What the Fed is about these days is the manipulation of interest rates. They have some fancy phrases for these. They call money printing quantitative easing. They want to lift up asset prices to help us, civilians, take a friendlier attitude towards the world and thereby help the macroeconomy improve. That's the theory.
That's the theory.
But notice, it's not their money they want to invest in. It's our money. As for what investors ought to do, as always, they ought to insist on a margin of safety and buy low and sell high. Am I making sense?
Yeah, of course, yeah. Common sense is not so common, as you say. But what happens, Jim? I mean, as you have pointed out, this has been extremely disrupting. I know you've even talked about creative destruction and the fact that the Fed is actually impeding the natural forces of capitalism.
Yes, the Fed seems bent on suppressing this most elegant thing we have called the price mechanism. The movement of prices determine all manner of things in a market economy, yet the Fed seems bound and determined to superimpose its will in place of the price mechanism. Take the bond market, for example. The Fed has hammered down yields directly and indirectly, and in response, people are throwing money at things like high yield or junk bonds. The inflows into mutual funds owning junk bonds are like 3 or 4 times what they were all of last year already. Yields on these speculative grade securities have fallen, the prices have risen. It feels great, but we're not sure. We can't be sure that these are the right prices. The prices the Fed wants, but are they the right prices? No, not necessarily.
Jim, getting down to brass tacks, how is a bond investor to deal with this current environment? You're calling actually for a bear market, am I correct?
And have forever. So I'm no help there. But it seems to me that a bond investor is almost better off in cash. If you were to go out 10 years in a U.S. Treasury security, you're earning approximately 2%, right? To remain in cash and be flexible, you're sacrificing those 2 percentage points a year. But you are not part of the herd that is being...
I read in your newsletter, if we go to the movies and we spend the money ourselves, it's almost the same, right, over a 20-year period.
Yeah, the bond market is a desert of value. There's simply nothing there. And yet, because it has gone up, because the Fed wants it to go up more, it is beloved by the professional investors. Somebody was quoted in Bloomberg story just the other day as saying, one of these $1 trillion plus bond investors, saying that he personally would not invest in securities yielding less than 2.25% per annum, because that's not really a value proposition. Less than 2.25%, more than, so he's going to wait until he gets back, the 10-year gets back to 2.25% from 2.
Right, right.
That ain't value as the ancients determined it, right?
What does this mean for gold? I know you've written about gold being the trade of the weary, not necessarily the trade of the frightened. Do you still see it that way?
Yeah, to me the price of gold is, as it were, the reciprocal of the world's faith in the deeds and words of the likes of Ben Bernanke. The world over, central banks are printing money as it has really never been printed before. The European Central Bank, over the past 3 months, has increased the size of its assets, its balance sheet, at the annual rate of 89%. 89%, Deidre. Look amazed. It's astonishing. and the Fed is far behind the bank. It's only like 15% over the past. The Bank of England is 67% over the past 3 months. These are rates of increase in the production of paper currencies really never seen in the modern age.
I was just going to say, yeah, no one's seen these levels.
And you know how they do it?
Go ahead, Jim.
It takes no effort at all. They simply tap a computer screen. So, we now all understand the meaning of the phrase quantitative easing, but many of us are left wondering the meaning of the word money.
We are back now with Jim Grant from Grant.